Here's an uncomfortable truth about safe money. You park your cash in a savings account and feel protected. And quietly, year after year, inflation eats it. If prices rise faster than your interest rate, your money grows and shrinks at the same time. More dollars, each one buying less. Now imagine a savings option that fixes exactly that. A bond, backed by the United States government, whose interest rate is rebuilt every 6 months to chase inflation itself. When prices climb, its rate climbs with them. That bond exists. It's called a Series 1 savings bond, an I bond. And it's one of the most misunderstood tools in personal finance. People hear government bond and assume it's complicated. It's not. So in the next 9 minutes, I'll take it apart. How the rate is assembled from 2 pieces, the timing rules that lock your cash, the ceiling on how much you can buy, and the tax break almost nobody talks about. So you'll know whether an I bond belongs in your savings plan. Let's start with the engine. An I bond's rate isn't one number. It's a recipe with 2 ingredients. The first is the fixed rate, the bond's steady baseline. When you buy, you lock in whatever fixed rate is offered that day, and it stays with that bond for its entire life. It never moves. The second is the inflation rate, the part that does the chasing. Every 6 months, the Treasury sees how much prices have actually risen and sets a new inflation rate to match. So this piece goes up when inflation heats up and down when it cools. Blend the two and you get the composite rate, what the bond actually pays. The official formula stacks them, the fixed rate plus 2 times the semi-annual inflation rate, plus a small cross-term where the 2 multiply together. You don't need to memorize that. The takeaway is steady piece plus moving piece equals the rate you earn. Let me make it concrete. For bonds issued from May 2026 through October 2026, the composite rate is 4.26%, built from a fixed rate of 0.90% plus annualized inflation of 3.34%. Compare that to the period right before. For bonds from November 2025 through April 2026, the composite rate was 4.03%. And notice the fixed piece was the same, 0.90%, while the inflation piece was lower at 3.12%. See what happened? The fixed slice stayed put. The inflation slice moved and that nudged the whole rate. That's the entire mechanism in one comparison. And one crucial reminder, those numbers are a snapshot from this period. They reset every 6 months, so by the time you watch this, the current figures may differ. The structure is permanent. The numbers are not. Now let's watch those 2 pieces play out over time, because the timing is where people get confused. Picture one bond stretched along a timeline. The fixed rate draws a perfectly flat line across the whole thing. It doesn't budge for as long as you hold the bond. And how long is that? An I bond earns interest for 30 years, then stops. So that fixed line runs flat for 3 decades. The inflation piece is the opposite. It steps up and down every 6 months. Sometimes higher, sometimes lower, following wherever prices go. Here's the detail almost everyone gets wrong. You've heard the rate is set on May 1st and November 1st. True, that's when the Treasury announces the new inflation rate. But your bond's rate doesn't switch on those calendar dates. It switches every 6 months from your own issue date. Buy in September, and your personal resets land in March and September, not May and November. 2 more things. First, the combined rate can go up or down, but it can never go below 0. There's a floor. Even if inflation went negative, the composite rate bottoms out at 0% and won't eat into what you've already earned. Second, after 30 years, the bond simply quits paying interest. Your signal, it's time to cash out. You understand the rate and the timing. Now the practical question, how much can you actually buy? There's a ceiling and it's lower than people expect. The limit is $10,000 per calendar year, per person. And per person means tied to your Social Security number. One Social Security number, $10,000 a year in electronic I-bonds, bought at TreasuryDirect.gov. The entry point, though, is refreshingly low. The minimum purchase is just $25, and above that you can buy any exact amount you want. So this isn't a rich person's tool. You can start with the price of a dinner out and climb to that $10,000 cap, and a useful wrinkle for households. Because the limit is per individual, a married couple can each buy 10,000. Two social security numbers, two separate ceilings, up to $20,000 a year between them. One more thing, because it trips up anyone working from old advice. There used to be a way to buy paper I-bonds, up to $5,000, using your federal tax refund. That option ended in January 2025. I-bonds today are electronic only, through your TreasuryDirect account. If a guide mentions the paper bond by tax refund trick, it's out of date. And limits like this can be changed by law, so treat the 10,000 as the current number, not a permanent rule. Now for the trade-off. In exchange for that inflation protection, you give up some access to your money. There are two distinct rules here, and seeing them as separate makes this click. Rule 1 is the hard lock. For the first 12 months from your issue date, you cannot cash an I-bond at all. Not with a penalty, at all. The money is simply frozen for a full year, so an I-bond is never a place for cash you might need next month. Rule 2 is the early exit penalty. Once that first year is up, you can cash the bond. But if you do it before you've held it for 5 years, you forfeit the most recent 3 months of interest. Then, after 5 years, the leash comes off. Hold past the 5-year mark, and you can cash any time with no penalty whatsoever. Fully liquid, you keep every cent. So picture a ladder. Months 0 to 12, completely locked. Years 1 through 5, open, but you lose 3 months of interest on the way out. Year 5 and beyond, free and clear. And a nice touch. For any bond under 5 years old, TreasuryDirect displays the value with those last 3 months of interest already subtracted, so the number you see is the honest amount you'd actually walk away with today. Last piece, and it quietly sweetens the deal. Taxes. How an I-bond is taxed is genuinely friendlier than a regular savings account. And it works in 3 layers. Layer 1, state and local income tax. On the interest your I-bond earns, you owe none. Completely exempt from state and local income tax. If you live somewhere with a hefty state income tax, that's a real built-in advantage over a normal bank account. Layer 2, federal tax. Here you do owe federal income tax applies to the interest. But you control the timing. You can defer it. You don't report a penny until you cash the bond, or it stops earning, or it reaches final maturity at 30 years, whichever comes first. So your money compounds for years without an annual tax bill nibbling at it. You can also elect to report the interest every year, but most people let it ride and pay later. Layer 3 is the bonus round. Big if you qualify. The Education Savings Bond Program. Use the bond's proceeds for qualified higher education expenses, and the interest can become fully federal tax-free. Not deferred, free. But there are strings. It phases out above certain income levels. Those thresholds change every year, and there are other eligibility rules. So it's a you may qualify door, not a guarantee. Check the current rules, or a tax professional before you count on it. And that's the honest reason none of this is financial advice. Your state, your income, your timeline all differ from the next person's. So let's snap it together. An I-bond pays a composite rate built from 2 slices. A fixed slice locked for the bond's 30-year life, plus an inflation slice that resets every 6 months to track rising prices, so your savings keep pace with inflation instead of quietly losing to it. In return, you accept rules, a 12-month hard lock, a 3-month interest penalty if you cash out before year 5, a ceiling of $10,000 per person per year at TreasuryDirect, and a tax picture that favors you, exempt from state and local tax, federal tax you can defer for years, and a possible education exclusion that can make it fully tax-free. Put simply, an I-bond is a tool for inflation-protected savings you won't need for at least a year. Not a get-rich investment, not a checking account, just a quiet place to keep cash from melting. And remember, every rate here resets twice a year. This is educational, not financial advice. Check the live numbers first. If this finally made the boring government bond make sense, hit subscribe. That's the whole mission here. The money tools nobody ever explained to you, made genuinely simple. And here's your perfect next step. The whole reason an I-bond exists is to fight one force, inflation. But what actually is inflation? Why do prices rise? And who decides how fast? I made a full video breaking inflation down from the ground up, the missing context behind everything we just covered. Watch that one next, and the I bond will make even more sense. I'll see you there.